Looks like stocks took a little bit of a breather after a strong breakout move last Friday. Technology stocks leading the way higher. So I'm going to break down the technicals that are really starting to paint a more bullish picture than we've seen for a while, and see if that leads us to expectations for a decent run here. And what's leading? What's leading, and does that impact those expectations? So I'm going to break the technicals and the rotations down from that standpoint. And today's trade idea has been a popular stock in the past, has not done much of anything for months and months and months, but today may be showing a sign of something to come. So we're going to look at that for our trade idea. Let's go ahead and get started. Today is Monday, March the 12th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. We're really glad to have you join us. Keep watching day after day. To help that, subscribe to our YouTube channel. If you haven't done that already, hit that red button down below the video. You can do that right now while you're watching. Also, hit that thumbs up icon right next to it. That lets me know a couple of things. Number one, it lets me know that you liked the video today, that you've got some value out of it. Number two, it lets me know you want me to do it again tomorrow. So it's a one-click, easy way to give me feedback on what you think. Comment on anything that stood out to you from today's video, any value you got out of it. You have to scroll down further to do that down below. Also, join our daily email list. You'll see a link to do that. I've highlighted it in the description of this video. I'll send out a daily Market Outlook email with time-stamped, hyperlink summaries of what we talk about, so you can kind of get an idea of what's in tonight's video. Follow me on Twitter for more content. In addition to these videos, you'll see my handle up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. I've got that also linked down in the description. That makes sure that Twitter keeps pushing you all my tweets. It also lets me know, again, another way of letting me know you want me to keep doing this. We kind of take a look to see how many likes we're getting, and see whether or not it's that you want us to keep doing these videos, obviously free of charge, out here on YouTube. Follow me on, join the Market Outlook community on Facebook. You see the address up above, as well as a link that I've highlighted down in the description. There's almost 950 of us now, so there's more and more joining every day. So be one of those. Come join us. All right, well, let's start by looking at the S&P 500 with the market forecast indicator. You can see we've got that renewed bullish intermediate posture again, something we've been looking for a while. We need to get it into the reversal zone if you want that market sentiment line to roll up. And you can see last time we were below 65, we rolled up, was with this low point here that eventually we pulled up from, and you can see the nice good run that we had. The near-term line is entrenched in that upper reversal zone, which is bullish, right? When it gets up here, you can see all these bullish highs that we've had, all of them in bullish highs. We've also had relatively bearish lows, so it's been a lot of volatility here since the pullback. But you notice, if you recall, this line here is a 23% return for the calendar year for 2018. So you see, we're still on pace. After that big decline in early February, late January, we're still on pace for what could end up being a 20%. And again, that number comes from the 5% plus return that we had in January. In years that we have that kind of return or better in January, the average return for that whole calendar year is 23%. So I just wanted to draw that line and kind of show what the pace would be for that. So we're kind of back in, the momentum line's down a little bit today. Not surprising. We had a big candle with a big gap on Friday, so a small candle today is going to bring it down. But as long as it doesn't bring it down to the reversal zone, to an extreme low point, then it doesn't really matter. You can see, and that was obviously a bigger deal. But even that, look how 3 down days, boom, 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 was quickly reversed within about a week plus. So right back up to new highs and getting closer to the pre-February highs when things were just so crazy bullish. And consider all the news that have come out lately, Gary Cohn leaving, the tariffs and all that, and the fact that we're pushing up just shows again how strong the bullish sentiment is and how hard it is to kind of go against that. Now, it might be easy to go against it within a day or two, but you get long lower shadows and you're right back at it again, like we see. So we look for the near-term line to be above 50, 7 to 12 days. So we see we got up there 1, 2, 3, 4, 5, 6 now, 6 days. So we're a day away from having a good near-term run, a good strong run. A day at the minimum, right? So potentially 2 to 3 more days, depending upon if we pull back following today at all in the near term. But if we did, it wouldn't be a bad deal because we've had a good run so far. And that near term, that intermediate posture is just kind of making, it's starting its rally. Kind of got here in mid-February. We had a little bit of a pullback there that gave it a pause. But now we're off that near term, that lower near term low to what is already a higher near term high point, and the trend is back on again. The game is afoot, right? If you look at the Dow Jones Industrial Average, same thing. It crossed down below 50, but you see how it's fluctuating around 50, getting back up above. Unlike the S&P 500, not quite up to new highs yet, so a little bit of a difference there. Its near-term line's also been above 50 for 1, 2, 3, 4, 5 days. Only 5 days compared to 6 for the S&P. The momentum line's a smidgen below 20th percentile at 19. So by definition, that is a bullish intermediate confirmation signal, but that's about as weak of one as you could possibly have. I guess you could have it weaker if the bullish posture was just climbing above 20, but it's barely getting above 50. That's a very weak bullish intermediate confirmation signal, especially with the near-term line kind of peaking and maybe a day or 2 or 3 away from pulling itself back down below 50. So don't put a lot of stock into that, but it could show us, that it could give us that little very short-term pullback that can propel it up for another couple of days and keep the near-term line in the upper half and get the intermediate line where the S&P's intermediate line is, where it's kind of, established above the chart's midpoint there. You can see the NASDAQ, which has been really leading lately. Its intermediate posture is strongly bullish. It has moved up to new all-time highs, having broken through on Friday. A good bullish move today. Small, drop in the momentum line again because of the small range. Could be beginnings of a near-term reversal there. But if we pull back, you're looking between 7,400 and 7,500 for some support from a couple of different high points here. So you're going to have some support if we do get a pullback. We can delete that. That line there. And then the Russell 2000, again, strong bullish posture, not new all-time highs, but a strong bullish posture, getting well up above these highs. Remember, the S&P is barely above those. The Dow is not above that high yet. So you can see the outperformance that small caps are having. Near-term line entrenched in the upper reversal zone. Intermediate line in that, so the NASDAQ and the Russell kind of giving us a preview of what could be coming for large cap stocks, which is what you want. You want these more, in the NASDAQ composite, it's got a lot of small cap influence. There's a bunch of big companies in there. So it's also got some large cap component too, specifically in that technology area. But there's also, the NASDAQ, the QQQ is the NASDAQ 100. That is a large cap index. But the NASDAQ composite contains it all. So there's a lot of influence on the Russell from the small cap universe on it. And so that's why you see both the Russell and the NASDAQ both really outpacing. Led also higher by those, it couldn't, the large cap components, the NASDAQ composite still by itself wouldn't go up without those big cap influences either. So they're performing well and small caps are performing well. And that's a good sign for market posture. So the posture is bullish on the markets. Near-term posture is getting a little mature, but still potential couple more days before we get a pullback. And of course, once we do get a pullback, especially if the S&P and the Dow, or at least the S&P were to extend more away from that high point here, if we go back to the S&P, then we can use this 2750 area. Even if we don't, we can use that 2750 area for a support level on any kind of near-term pullback and a new, potentially higher low point that we can launch up from for a new 7 to 10 day near-term run. So we got back up above the 50-day moving average on the long-term chart last week. So another arrow, and we're getting lots of arrows. So now, there could be a week or two that we stay above a rising 50-day moving average, as well above a rising 200-day moving average. Now, eventually, that 200 days is going to catch up to the 50, like we've seen before. And in the meantime, while it does that, there's going to be some up and down volatility. It might go a week or two before you get another arrow. But again, and depending upon where that 50-day moving average is in the next near-term pullback, we might hit this 2750 area for a new support and then continue to ride higher. Now, remember the NASDAQ composite, it's already above it. You can see it's got a good distance away from the 50. So, and you look at the Russell 2000, same thing. getting easily back up above that 50-day moving average. So it doesn't look like either one of those two are a threat to get a new arrow this week or anytime soon. But in another week or two, depending upon the near-term pullbacks, we could get a red arrow. But like we've seen before, that usually is followed up by another green arrow until the gap between the 50 and 200-day moving averages gets smaller, right about this 50-point level in the past, and that's where you can potentially get the sharp drop below the 200 that sticks instead of the ones that come over and we bounce right off like we've had just a few weeks ago, where we on an intra-week basis. Looking at the 3 green arrows, we're back to having 3 green arrows on the chart. So we're above the 30-day moving average. I remember in the I taught a technical analysis class last week, kind of a beta version of what we're going to be offering, a test run of what we're going to be offering in our Market Scholars on our website. One of the classes that I will be teaching, and we talked about the stages to trend reversals using these moving averages that are involved with the MACD. And the last stage was the 8 and the 17-day crossing up above the 30, which you can see now we have. And we also talked about, I believe it was on this day that we had the class, we kind of polled everybody to say, okay, where, now that we're converging, where's the next divergence going to be? Is it going to be to the downside or to the upside? And it was kind of a 50-50 split, but we talked about the expectations for the upside because of what we taught in that class, and lo and behold, that's what we got by Friday. Was now a divergence now back to the upside with that break up above. In fact, it happened on Friday to get the 8 and the 17 up above, and now getting further away. And you can see the positive MACD after coming off sharp low points usually end up getting right back up to the bigger high points too. Before, and probably will do that before we get the next near-term pullback. So today's this 1 day pause. I wouldn't be surprised if we don't come up a little bit more, especially on the S&P, similar to what those small cap indexes have done. We look at the intraday chart here, and you can see we gapped open again to the upside and hit a new 4-week high point. So, like I mentioned before, we're in the upper half of the range. That lower end is going to be moving up now. It's already starting to move up. We'll move it up again tomorrow, and then the day after that, and then on Thursday, it'll be moved up there and stay at 265 for a while. So, looking at a 15-point range right now. So what, 7.5 points would be 272.5. So right there is your midpoint. So as long as we stay above that high point here, this area, we're in the upper half of the chart. There's no bearishness there. So we continue to stay in the upper half. We're pushing up to new highs. That's bullish. It continues to show bullish for us. And you also see too that the range is coming down. The range today was just under 2 points. The volume is look how fast the average volume is dropping, and we taught that before too that that's a bullish sign. So the range is below 2, the volume below 71 or 72 million. So these lines are coming down fast. That's typically a positive sign. Volatility is also starting to come back down, so this actually needs to move a little bit lower down to a new low point at 15. We're forming a high point right now. Just I guess we're almost there above 50 on the volatility, so we'll see what ends up coming out of that. If we end up peaking around 17.5, then look for another renewed move down to 12.5 for volatility. I don't think we'll get back down to 10 or lower. Anything can happen, but I think we're in a higher volatility regime now, and the lows are going to be higher than what we've seen in 2017, where we were around 10 or lower for a long time. So that being said, that's what volatility is doing on an absolute basis. On a relative basis, you see it's back below the neutral area, so back below that 90 to 95% range at 89%. So back in bullish. So a lot of these accompanying factors here are kind of confirming this bullish posture and leading us to expectations that will continue to ride this intermediate trend. How long? Again, the expectations 1 to 3 months is normal. And considering where market sentiment is, probably about 2 months is the expectation from when we crossed above 50 here in mid-February. And we talked before too, from a seasonality standpoint, March and April on the calendar is the best 2-month combination of the year. So that's a good sign from a seasonal standpoint heading into spring. You can see it was kind of flat last year. But over the last so many years, if you look at it from an almanac perspective, tends to be a good sign before we head into what is usually some late spring weakness, May and June area. On the economic calendar, you can see not a whole lot going on. Typical for Mondays, not a whole lot going on there. Economic surprise index not doing so well globally, but here in the U.S., which supposedly we're supposed to be, we're supposed to have all this kind of headwinds going for us, but we're doing better from economic surprises when you're looking on that basis. GDP is down. The estimates are back down to kind of the lowest level that we've seen, down to 2.5%. That's lower than where we were over 5% in one period initially. So you can, the economic estimates are pulling back. If we take a look at the impact that that's having on different asset classes, you can see, looking at really from the, with a little bit of a pause here from this low point on, here's what's driving. There's your stocks are up 5% off that low point, 5% move in just like a week plus. But look at small caps outpacing, look at emerging markets outpacing large caps. Bonds have been down 1%, yields are rising. But if you look at what's going on today, bonds are actually up the most today. Stocks are up too, but bonds are up the most, as you see, falling economic estimates, kind of moderating economic surprises, falling GDP estimates, and that's leading to a little bit of a pullback in the odds for that second rate hike in June. So this is the June month here. March is guaranteed, pretty much guaranteed, 88% odds of a rate hike. Second one, they're still pretty decent, 72% odds that we'll get a rate hike in a second rate hike by June. But that's down. You can see from about 77%, and the odds of only getting the one by June ramped up just a little bit. Still low percentage, right? 27% total. So still low percentage, but it's better than 22%, which is what it was a day ago. So on Friday. So just a little bit of a pullback in those interest rate hike odds. You can see, what the 10-year note and how it responded to that. You can see it's, so far above these moving averages, and we've seen what happens to it, and we've talked about that. It kind of pulls back down to these things when we get so far away. So don't be surprised if we don't grind towards 2.6% for a while, right? You see, it takes a while to grind back down, so it could grind over the next so many months back down to this support level at 2.6. And considering how bearish that sharp move up was, that could be a positive. And even with bonds rising today, you still saw the risk assets like emerging markets and small caps doing well. What kept the market down, you can see with crude oil prices really pulling back down about 1%. We can take a look at the futures here. You see what the futures contract's doing. It's kind of moderating about this 26. In fact, you can see here, let's look at a longer time frame so we can see it a little bit better. Let's get rid of these studies for a second. So you see how it's kind of forming a triangle, and the expectation would be to, because we're bullish heading into the triangle, to be bullish coming out of the triangle once we do get that. And this level here was a big resistance for it at $60. So not surprising that it's having a hard time kind of getting through it. It did get up to 66, but now we're kind of coming back, but we're still above 60. So again, based on the price pattern, you would expect a breakout to the upside. Doesn't mean it has to happen because nothing's ever 100% technical analysis, but that's what you'd expect on the consolidation, especially considering the consolidation is taking place above an important support level for crude oil. So we've seen in the past that that's been a risk asset class that's helped push sentiment higher, and today happened to pull it down, but not enough to produce losses. A small loss for the S&P 500, but not for these other asset classes. And really the only, you have bonds, long-term bonds outpace high yield pull back a little bit, and gold outpace crude oil, but the equity assets all outpacing everything but long-term bonds. So this wasn't bearish enough to be bearish overall for the market, just bearish enough to hold back on the gains from what we had initially this morning when crude oil was at its peak for the day. So something I tweeted out was the gains we're having so far. If you take a look at so far in March, and really the end of February is that point right there, but really off of this low point in March. The March gains right now are above 3.5%, or right around 3.5% for the month. But off that low point in March, we're up that 5%. And there's your leaders. Technology, financials leading the way higher. Technology, that momentum area continues to provide a lot of momentum. Utilities still lagging, at least they're gaining, but they're lagging. Look at real estate though. Real estate, which had been a really underperforming sector, let's go out 6 months here, really has been an underperforming sector, starting to get some relative strength going. That kind of been bad. Remember how poor the housing numbers have been in different areas. You can see a little bit of a breakout here on real estate. After coming off of some lows. Utilities still has some ways to go. So this isn't an interest rate move. Probably a little bit more of a real estate move here. Staples still lagging behind, but again, off that low point. Technology leading, everything else lagging. This has been a one sector move. In fact, that's that new acronym I saw it tweeted out by a few people. MANIA being the new acronym with the different tech stocks in the Nasdaq that have making up a big chunk of this strong momentum gains right now. So one previous stock that has been a high flyer in the past, obviously, Tesla, has really not had a good year. It's been about as sideways as you can possibly be, trading a little bit above 375 on one end, trading about 300 on the lower end. Up and down, up and down. Higher last year, lower highs and lows here this year. But this year, you can see in January we had a 3 green arrow move with a spike in volume that went off a little bit. We tried to hold that support, and then earnings came out and pushed us through, but not through the new lows. We didn't get down below 300, form a long lower shadow, some support down below that. Rallied back up to those same highs. Not necessarily a 3 green arrow spike in volume this go around here, but pulled back to a higher low point, and now bouncing off of what would be a higher low point with a new set of 3 green arrows, almost 3 green arrows here on the MACD, almost getting above its moving average as well as above zero, with the stochastics forming the potential of a phantom green arrow as well. So when you look at the market forecast, you can see its intermediate line never did get below 50, turning up higher, near-term line turning up. All good signs. You can see the Bollinger Bands are relatively wide, so we've got some room. There could be some volatility within these lines, but look for a breakout above these levels here, which also would be a breakout above that Bollinger Band if we're really going to continue to push up the 380 or beyond. The spike in the 3 green arrows and the spike in volume on the sideways trends gives us that suggestion. Of course, like I said, nothing's ever 100%. That one didn't work. You put your stop order below that low point, and potentially we're stopped out on that earnings announcement when we come down to 310, depending upon how much room you give yourself below support. Sometimes you might give yourself, depending upon the stock and how volatile it is, you might give yourself more room than if it were, say, a consumer staples company that doesn't have very much volatility. But regardless, a good chance you probably got stopped out there, but only to offer a new opportunity now with a new set of three green arrows and a spike. So again, just looking to see if this ends up turning into, because I'm not looking for a move just up to 375. We're looking for a trend. When I'm trading a stock, I want to see if it will start a trend. It's got a lot of potential energy storing up here. If it's not been trending, it's been sideways trending at best. So there's a lot of potential energy, months and months of potential energy storing up, that once we do break out, then we might get a decent move. So what you could say is, okay, well, if it's not trending yet, maybe instead of starting, going full bore with my position sizing, maybe I start off here with a smaller position than what I normally do. And then once we break out to new highs, with another set of 3 green arrows, then I'll add to a position once that trend gets established. And here I'll kind of start off small with a half a position. And that way, if it does take off, I got something. I got a really good return on something. Then once I get more, then if it doesn't pull back and I get stopped out like here, then I get a small loss because it's a small position. But if it turns into a really good trend, then I can add to that position and build into the winner and get some good solid gains out of it. So it's an early warning sign or early signal here. It's 3 green arrows in the spike in volume and a sideways trend. That could lead to what we've been waiting for on Tesla, or what a lot of people have been waiting for on Tesla for months and months and months, which is a good, solid, new long-term trend that will bust these long-term moving averages that are right now converging with each other, that will bust them out and diverge again after converging. So we'll see if that ends up being the case. So there's an opportunity to take advantage of a stock that is in that high-flying sector that may be offering some relative strength value right now, even if the stock itself is, typically pretty expensive. But in terms of relative strength, might be offer some rotational value right now as people look start looking for more opportunity to keep the bullish intermediate run rising for potentially most of this calendar year. So to summarize, the market looks like it's got a good bullish posture restarting again, led higher by what you would want to lead it higher at the beginning of an intermediate run, which is small caps, riskier asset classes, the technology sector. So good market leadership, good rotations. A lot of these technology stocks have been making a decent run, so that's why in today's trade idea we try to find something that may offer some potential for a decent run in a sector that's offering some momentum and some market leadership. So that's our video for today. As always, thank you very much for watching. We really appreciate the time you spend and the engagement. Remember to like, subscribe, and comment on the video down below. Again, follow me on Twitter for more content. I've been a little light as we've been working on some things on the site here. And again, if you were on our survey, if you did our research survey late last year in December-ish, January-ish, then you should have been receiving some follow-up emails to that. If you haven't been, let me know, david@marketscholars.com, and we can make sure that you get those emails and know what we're doing with the site. So have a great evening, everybody. Thanks again for watching, and we'll see you all tomorrow.